On August 10th, Nvidia signed deals with 6 of Wall Street's largest asset managers to create a $500 billion GPU financing platform. The pitch: AI chips are infrastructure, like toll roads, like power plants, and they deserve institutional debt financing. The same day, Apollo's chief economist published one number. The companies buying Nvidia's chips, the AI labs, the model builders, are running at negative 59% operating margins. They are losing money faster than customers can pay them. Nvidia just got Wall Street to lend money to loss-making companies to buy Nvidia's products, and retained a $125 billion backstop in case it goes wrong. That is not a partnership. That is the most audacious demand creation scheme in tech history. Jensen Huang's argument on August 10th was simple. A toll road generates predictable usage-linked revenue for 30 to 50 years. A power plant does the same. Both are financed with institutional debt because the cash flows are stable and the assets hold value. AI compute, Huang argued, should be the same. The demand is permanent. The revenue is predictable. The asset class deserves hundreds of billions in institutional lending. Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, KKR, 6 firms, over $500 billion in potential financing capacity. What Huang did not address is the detail that changes the entire economic logic of the deal. And Thorsten Slock at Apollo, one of the 6 firms that just signed, published exactly that detail the same morning. Thorsten Slock, chief economist at Apollo, broke the AI value chain into 4 layers: silicon and equipment, cloud and compute, energy and grid, and models and applications. Silicon and equipment. Chipmakers, Nvidia's tier, earns 41% operating margins. Cloud and compute layers earn mid-single-digit margins. Energy and grid earns low double digits. Models and applications. OpenAI, Anthropic, every AI app company, operates at negative 59%. Slock's exact words: the AI boom's profits are currently being funded by investors rather than earned from customers. The upstream margins are real, but they are paid for out of capital raised by the layer losing money. That upstream margin is Nvidia's 41%. The capital paying for it is investor funding into the loss-making model layer, not customer revenue. Investor capital. The financing platform does not fix this. It changes the type of investor capital from equity to debt. The math is the same. The interest payments are not. If you want to track where AI money actually flows every week before it's obvious, subscribe. That is what we do every Tuesday and Friday. The toll road analogy breaks on one variable: the depreciation timeline. A toll road holds value for 30 to 50 years. An institutional lender models decades of cash flows with confidence. A Nvidia H200 GPU cluster has an effective economic life of 3 to 5 years. Not because it stops working, because the next generation makes it obsolete. The H200 is already being displaced by the B200. The B200 will be displaced by Blackwell Ultra. Each refresh cycle reprices the previous generation. The Motley Fool noted this directly. Nvidia's financing plan is 20 times the scale of what the telecom bubble ran on, and telcos were financing assets with 10 to 20-year lives. The MOUs signed on August 10th are not committed capital. They are frameworks. Each firm will establish independent lending platforms with their own risk parameters. The unanswered question: who holds the loss when an H200 cluster is worth 40%? Less in 3 years than the outstanding loan balance? And Nvidia's answer to that question is built into the deal structure itself. Nvidia retained a $125 billion first loss backstop in the structure. That is 25% of total announced capacity. No institutional firm finances a novel asset class without the originator holding meaningful risk. Blackstone does not lead without the developer on the hook. That backstop tells you what the lenders demanded. It is a self-insurance premium against the possibility that GPU compute does not behave like a toll road. Now look at who the loans are for. Jensen Huang described the target market directly. Companies that lack the credit rating or cash to buy GPU clusters outright. Not Microsoft, not Google, not Amazon. Those companies have the credit. The target is the tier below, the AI startups and mid-tier labs already running at -59%. Margins who cannot raise enough equity to pay for compute outright. These companies now take on debt-financed GPU leases at interest secured against hardware that depreciates in 3 to 5 years. Their cost structure, already unprofitable, now includes interest payments. Their collateral depreciates faster than the loan. Their revenue still does not cover operating costs. The platform shifts investor capital from venture equity to institutional debt. The fundamental math does not change. The pressure on the borrowers gets worse. Nvidia wins immediately. They move demand risk from can customers afford to buy to can customers afford to service debt. Companies that couldn't raise equity can take a loan. Nvidia sells more GPUs. The 6 financial institutions win on origination fees, interest spread, and servicing revenue. They are not holding GPU obsolescence risk. They are fee businesses on a novel asset class. The AI companies taking the loans lose eventually. The compute is real. The models are real. But a company with a leveraged GPU lease, a 5-year depreciation clock, and -59%. Margins cannot stop servicing debt the way it can stop spending equity. Venture capital gives you the option to cut and extend runway. Debt requires you to service it or default. Here is the scenario nobody is modeling. The most dangerous outcome is not the companies that default in year 1. It is the companies that survive 2 years, build real products, and then face the GPU refresh cycle. Their H200 cluster is now worth 40% less. The loan balance has not moved. The next Nvidia generation is being sold through the same financing platform to their competitors. The toll road does not become obsolete in 3 years. The H200 does. That is the trap. Jensen Huang convinced the largest institutional asset managers in the world to become the financing engine for his customers. $500 billion. 6 firms. GPU compute repositioned as infrastructure, toll roads and power plants in silicon form. The same day, Apollo's own chief economist published the data showing that the companies buying those GPUs run at -59% operating margins. Not funded by customer revenue, funded by investors. The financing platform is a new channel for that investor capital. Equity rounds become debt facilities. The fundamental math stays broken. The interest clock starts. The plot twist. The companies most at risk are not the ones that fail fast. They are the ones that survive long enough to need a GPU refresh and discover that their 3-year-old collateral is worth far less than their outstanding loan. The toll road holds value for 50 years. The H200 holds it for 3. Nvidia solved its demand problem beautifully. The question is who solves the borrower's depreciation problem. To track who is structurally positioned to win the AI infrastructure war and who walks into traps like this one, subscribe. We break it down every Tuesday and Friday. Drop a comment. Is the GPU financing platform the infrastructure play of the decade, or the most sophisticated demand generation scheme Nvidia has ever built?